Well, good morning and welcome to the Reserve Bank. With me, I've got Grant Spencer, who's the Deputy Governor and Head of Financial Stability. New Zealand's financial system is sound, but continues to face risks. Global growth has been subdued despite extremely accommodative monetary policy in many countries, and financial markets have remained volatile due to heightened political uncertainty. Dairy prices have recovered in recent months, and the average dairy farm is expected to be profitable this season. However, debt levels have increased over the past 2 years, and problem loans are likely to continue to increase for a time. House price inflation in Auckland has softened in recent months, but it's uncertain whether this will be sustained. Auckland house price to income ratios remain among the highest in the world, and prices continue to rise rapidly in the rest of the country. There is a significant risk of further upward pressure on house prices so long as the imbalance between housing demand and supply remains. The Reserve Bank has asked the Minister of Finance to agree to add a debt-to-income tool to the Memorandum of Understanding on macroprudential policy. While the bank is not proposing to use such a tool at this time, financial stability risks can build up quickly, and restrictions on high DTI lending could be warranted if housing market imbalances were to deteriorate further.
Of course, the new investor LVR restrictions came into force on 1 October. These restrictions, along with the earlier LVR measures, are increasing the resilience of bank balance sheets to a downturn in the housing market. However, the share of bank mortgage lending to customers with high DTI ratios has been increasing, and this could worsen the rate of loan defaults during a housing downturn. The banking system has strong capital and funding buffers, and profitability remains high. Despite being relatively concentrated, New Zealand's banking system appears to be operating efficiently from an international perspective based on metrics such as the cost-to-income ratio and the spread between lending and deposit rates. However, the banking system's reliance on offshore wholesale funding is beginning to increase due to a widening gap between credit and deposit growth. Banks could become more susceptible to increased funding costs and reduced access to markets in the event of heightened market volatility. Damage from the 7.8 Kaikoura earthquake on 14 November is being assessed. While it's too early to estimate the cost to insurers, the sector is well positioned in terms of catastrophe reinsurance cover and capital buffers. And finally, the Reserve Bank continues to make progress on a number of regulatory initiatives, including a review of bank capital requirements, amendments to the outsourcing policy for banks, and a dashboard approach to quarterly disclosure.
Well, let's open it up for questions. So thanks very much.
Governor, are you concerned that the recent uptick we've seen in some fixed mortgage rates will be putting those leveraged borrowers you're talking about under real pressure, and can they cope?
Well, we've certainly seen an increase in mortgage rates, and just as we've seen, an increase in deposit rates as well, as banks are finding that their credit growth is exceeding their deposit growth, and they're having to basically access offshore wholesale funding, which is more expensive, and also they're having to compete more to try and get the deposit inflows as well. So you are seeing those rates rise. If you look at the proportion of floating rate mortgages, in terms of total mortgages, they're around about 23%. And if you look at the proportion of borrowers who are fixed for less than 1 year, then that's about 40% of total outstanding. So you could sort of say that people who are floating or fixed with less than 1 year represent around 65% almost of total outstanding borrowings. So those people are susceptible, of course, to an increase in mortgage rates. We are seeing, if you look at household debt as a share of household disposable income, we're at a historic high. We're now at levels that are higher than the pre-GFC, so they're around about 165%. If you look at the DTI ratios, debt to income ratios, in terms of lending above a ratio of 5, that's been increasing for first home borrowers. And so there is an element that some people, yes, they will be vulnerable if mortgage rates do continue to rise. One thing that is quite encouraging at present is the volume or the value of commitments, loan commitments, is falling quite appreciably at this point. So if you take the data since let me just check when it is, since April, then the value of commitments in total is down almost 20%. Now that's a very substantial decline in commitments. It's dominated by investors. Their commitments are down about 30%, and non-investors down around 8%. So what I'm saying is there are some borrowers out there who are more vulnerable. We've seen an increase in high DTI lending in terms of ratios over 5, and that's increased for first home borrowers. We know total debt levels are high in the economy relative to household disposable income. But at the same time, we're seeing some quite encouraging drops in the value of loan commitments in terms of new commitments.
So, I mean, we have been giving that caution for some time that people need to be very careful about borrowing increasingly large mortgage amounts at very low interest rates because it's only a matter of time before rates do increase. And if you look internationally, in recent weeks, there are indications that those global interest rates have turned up. How far that goes in terms of the trend remains to be seen, but I think a lot of people are saying that we may have seen the bottom of the global interest rate cycle.
Just on the debt-to-income ratio request to the Finance Minister, he seems to have had that for quite some time. Are you making a sort of pointed message to him today to hurry up?
Well, we've had a request in to include DTIs in the Memorandum of Understanding around macroprudential policy. We've had a couple of discussions with the Finance Minister, I think, in the last 2 to 3 months. He's asked for additional information. He's asked a number of questions about what policy problem is it addressing, what are the circumstances in which we'd use it, who would be most affected, how does it fit in with loan-to-value restrictions and other operational issues. So we've had discussions on those sorts of issues. We've got another meeting scheduled, I believe, for a couple of weeks' time. So hopefully we'll get further clarification then.
Governor, you've noted that at this time you don't think there's a need to use the debt to income multiple control. What sort of change in the housing market or the prudential risks would you describe which would change your mind so that you might need to use it? I mean, would you expect a big surge in house prices, or what sort of things should we be looking at?
Well, we've indicated that we'd want to continue, of course, to closely monitor the housing market. We've seen house price inflation moderate in Auckland for a few months now. We've also seen the same for the rest of New Zealand for a shorter period. So we can't be sure, given that we've still got low interest rates, we've still got strong migration flows, we can't be sure that that will continue. So we've indicated we'd want to monitor that. I think what we'd need to see is we'd need to see that there's a resurgence in house price inflation, that it was picking up in Auckland and also picking up further in nationally. And we'd want to be clear that it's credit related, with commitments expanding and continued increases in DTIs. What we are seeing is an increase in the DTIs in terms of lending above ratios of 5, for example. But we are seeing quite a significant decline in the value of commitments, and I just gave the data on that. So.
You've given some new data in the Financial Stability Report showing that more than 60% of investors have a debt-to-income multiple of over 5. What would you see as a prudent level from a financial stability risk point of view for any potential multiple? Is it 5? Is it 6? Do you have a view?
We don't have a fixed number. I mean, the banks clearly have to make their assessments, but we have been concerned that average multiple has been drifting up, has been increasing. And as I say, if you're against an environment where low interest rates, where the direction of anything's going to be upwards, that's you have to have some concern about that. But the actual rate for any particular borrower will be specific to their circumstances. I think if we did, if we were in a position of designing a debt-to-income macro-prudential tool, it would, it wouldn't be a definite number, nothing more than a fixed ratio. It would be of a similar speed limit type that we've had with the LVR restrictions. We'd say a certain amount of borrowing can be over a certain multiple.
If you look in the UK, for example, I think the ratio they have is 4.5, with a requirement that no more than 15% of lending take place above that DTI ratio. Now, I'm not giving any indication of our thinking in terms of a particular ratio, but would probably be that sort of concept.
Why? Hello. The earthquakes. Why doesn't it pose, or why have you said it doesn't? It's not likely to present a risk to the financial stability.
Well, we think that the insurance industry is pretty well set, pretty well prepared for shocks of this sort. Since Canterbury, they have built up re-established reinsurance cover, capital buffers, so that the industry overall is we think, well covered for catastrophe risk. Part of that's related to prudential standards that we are setting in terms of the extent of that cover required. So, in terms of the sort of magnitude, clearly it's going to be substantially less at this point, notwithstanding the risk of aftershocks. the numbers are substantially less than for the Canterbury situation.
Is there any concern about bank funding for property development in Auckland? Are you seeing any signs that that's becoming harder, and is that putting housing supply at risk?
Well, that's a tricky one. I mean, we have to be concerned about the risks that banks are taking in property development, because that tends to be a very risky sector. So the banks are being cautious. They are, particularly in their overall funding situation now, they're looking to be cautious from an overall portfolio point of view. And one of the sectors where, there's particular risk is in property development and development of new apartments. So I think over the industry, they're taking quite a cautious approach. Now, you might say, okay, well, we should be encouraging them to increase supply, but at the end of the day, we have responsibility for, supporting the stability of the financial system. So we don't want them to push that form of lending more than they're comfortable with.
You have seen banks tighten their credit criteria, and you've seen that in respect of overseas borrowers who have overseas income, and the bank's inability at times to validate the flow of that income and therefore support the servicing of the loan. So you've seen a cutback in that sort of lending, quite significant. And you're also seeing, as Grant says, the banks evaluating the credit risks associated with some of the apartment developments.
Just another question in regards to the Kaikoura earthquake. One of the risks to the economy is the dairy sector. Are you at all concerned that that dairy sector might be further impacted in terms of some of the structural damage we've seen from the earthquake, with roads, etc., being destroyed, not being able to get their goods out for shipment? And further to that, can some of this structural damage pose a risk that the quake hasn't in terms of insurance companies?
If you look at if you look at the dairy sector, there's been a really quite dramatic turnaround in the prices. If you take, for example, whole milk powder, I mean, that last auction was, I think from memory, about $34.20 US a metric tonne. Now, if you went back to August last year, that price was around $15.90 US a metric tonne. So at this point, we've seen Fonterra indicate a potential payout this year of $6. Plus, of course, there's a dividend, possibly of the order of 50 to 60 cents. So you might be looking, if that plays out, at a payout plus dividend of maybe around $6.50. And Dairy New Zealand last year was saying that the break-even was about $5.05. So a lot of the farmers are better off in a more profitable situation. One of the challenges has been the cutback in milk supply, which is pretty acute in the Waikato district, but for New Zealand overall might be about 5%. So if you look at the dairy sector, in many respects, it's had a very significant bounce back, and hopefully that will continue. It's clear that the freight costs for Christchurch, Kaikoura will increase, possibly quite significantly. We're seeing some increases already. But I'm not anticipating, but do stand to be corrected, but I'm not anticipating that this is going to have a dramatic impact on the dairy sector.
Just back on the quakes, so is the economy at risk of any of the other things associated with the quakes, like the roads being out of action, the rail line being out of action, tourism being affected in Kaikoura, Wellington's port mainly being out of action?
Well, that's right. There's a lot of business disruption, and we don't have a good handle on exactly the extent of that. So typically with the impact on GDP projections from an earthquake, say with Canterbury or this one, you'll get some downturn as there's lost business, so a weakening of activity, and then a pickup as the reconstruction starts. But there's also the factor of the sort of mop-up operation short term that actually compensate in terms of the aggregate level of activity in that initial period. So we don't, in terms of an initial look at our GDP outlook, we don't think that's very different at this point in time in terms of those sort of net of those two effects.
If you look at some of the estimates around, and it's very early days at this point, and we all learned from Christchurch how wildly inaccurate the early estimates of reconstruction could be. You're seeing estimates out there that range anywhere from sort of 1 to 8 or 9 billion, somewhere in that range. So it's a wide range. We know that aftershocks can also change the situation quite dramatically. But if you look at it relative to the total economy, the economy is about 250 billion in terms of GDP. And if you look what's driving growth in the economy, it's the very strong investment growth that we've been seeing. It's high tourist numbers, record tourist numbers, record migration flows, and very high, historically high labour force participation. So that there's a lot of momentum in the economy. So, we're still learning about the potential costs and impacts, but at this point, that's our view at present.
You've noted the increased reliance on offshore funding by the banks in this report, and that they'll need to replace about $40 billion worth of market funding within the next 3 years, which counts towards the core funding ratio. Do the banks have room, given they're a bit above that 75% core funding ratio, do the banks have room to absorb that? Do you think they'll have to take extra action to encourage more local term deposits or do something differently with longer term bonds?
Well, their first port of call is to increase deposits, and that's effectively what they're doing now. That's why they're tending to push deposit rates up, because they've found that the rate of growth of deposits has fallen off over the past year, while credit growth has continued to increase. So that gap has increased. Now, so the first option is to push up deposit rates, be more aggressive for an individual bank, and to try and recover and get more deposits in the door. So that's what they're doing. But eventually the cost of doing that comes up to the cost of going offshore. And so now you've sort of equalised, it's pretty close. The cost to a bank of getting new deposit funds and getting offshore funds is similar. And so, and there's a question about, is it a zero-sum game? If the banks increase deposit rates, does it actually increase the size of the cake, or are they just taking deposits off each other? That's not altogether clear. But it is apparent that the system overall is having to borrow more offshore, and that's happening now and in recent months. But it's not something to panic about. The markets can absorb that additional borrowing. The offshore market's relatively benign at present, but it's a risk if that continues, because the more offshore funding the banks have, then the more exposed they are to any international volatility that comes down the track.
So the core funding ratio is currently set at 75%, and I see the banks are up to 86%.
Right.
Has the Reserve Bank thought of increasing that minimum any more to further reduce the funding risks longer term?
It's not on our radar at present, but we reserve the right to review that core funding ratio level. And of course, the core funding ratio is one of the tools in our macroprudential toolkit. But it's been set at 75% for some time, and there's no imminent prospect of changing that.
You mentioned the capital review in here around, I think it's the risk weighting issue. Where are we with that, and what are the prospects for increasing capital requirements for the banks over the next few years?
Well, we're in the early stages of a review of capital adequacy for the banks. We would hope early in the new year to set the scene in terms of the principles and framework that we will set for that review, and then it'll probably take some time to play out in terms of the different components of that and setting new requirements, new standards. We need to look at it in the context of what's happening internationally as well. New standards coming out of Basel late this year, probably now early next year. Australia also is still going through their review. So our review will be in the context of that. It's too early to say whether capital requirements will increase or decrease, but, well, I guess it's fair to say that we don't expect them to decrease.
Another Quakes question. You mentioned that the overall cost of rebuilding after the quake could be wildly different to what was initially predicted, which is we're currently around $2 billion. It's the assessment, it seems. Do you think that the government should maintain a certain amount of surplus in the bank to pay for the earthquake, given that the costs might increase, and would, say, fiscal stimulus from the government to the taxpayer hurt the ability to pay for the quake if it does come in at costing more than $2 billion?
Well, we think that the government finances are in pretty good shape, and so we don't think they would have difficulty if the actual costs turn out to be, more than the $2 to $3 billion initial estimate. I would add that $2 to $3 billion, I think, is a government cost, particularly around the infrastructure replacement, etc., in the top of the South Island. I think in terms of the total cost, you need to add in the expected insurance cost, which could be, we think in early estimates, sort of in the $1 to $5 billion territory. So in terms of the total cost potentially of the Kaikoura quake, you're adding those two components together to get something in the order of sort of $3 to $8 billion. Part of that's covered by the insurance, part of it is the government.
If you look at New Zealand's fiscal policy record over a number of years and you compare it internationally, it's a pretty impressive record in terms of surpluses or pretty close to surpluses. And also if you look at what's been happening to net public debt ratios, again, it's an impressive story. The government will need to make decisions in terms of what it does with its fiscal position and the split of that in terms of the possibility of measures on the revenue side, albeit infrastructure, albeit current consumption. But at this point, you've got an economy growing at around probably 3.5%, and at this stage, based on how we're interpreting things, it's not an economy that's in need of substantial fiscal stimulus at this point.
Just on the issue of insurance, yesterday the chairman of Tower, Michael Stasny, came out and said that he was concerned about the delays with the EQC review and pointed to warnings from Swiss Re that these delays could significantly increase the reinsurance premia for New Zealand across the board. Does the Reserve Bank have a view on how the EQC review is affecting the insurance industry and what that might do for premiums, and does it have any issues with capital levels, or what's your general view on that?
We don't think that's a big issue. I mean, that review is making progress. We having input into that, but we're not driving it, obviously. I haven't read Mr. Stasny's comments, but we don't think there's any particular alarm about the EQC review.
Just one from me to the Governor on the debt-to-income multiple limit. Do you think, given what you're seeing at the moment and the state of the discussions with the Finance Minister, that it's likely that we'll see any debt-to-income multiple applied before the end of next year?
That I don't know. As I say, we've had 2 discussions, and we'll have another one in a couple of weeks' time, and we'll learn more then. So thanks very much indeed.